If you look at all the other figures, you would say that, yeah, things are sitting for ages, things aren't selling, prices are coming down. But when you look at that days on market, that is showing you, and that's the indicator that there are places that are going very, very quickly.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined, as always, by David Warren. We are both mortgage agents, level 2. We're coming to you live from our nation's capital here in Ottawa. Want to take a quick second to thank our amazing sponsors, Gerté, Poirier, Avocat Lawyers, Big Insurance in Westboro, and CENTUM. Thank you for your support. Thank you for listening. David, how you doing? What's going on?
I'm good. First of all, I want to thank yourself and Sandra and others for coming out to Martini Madness last week. I got a chance to actually meet a couple of listeners who actually bought tickets because of listening to the show and seeing the shorts, which was always, like I always say, it's also hilarious when anyone tells me that they listen to us ramble. But that they actually came out and supported. It was great. It was a good night. Like we're about 350 people. We were able to raise over 120,000 on Thursday.
Incredible.
For Crohn's and colitis, which was great. Like I said, good turnout, great time. I think a few people woke up Friday, maybe a little not, as functioning for work as they would normally have been, but good time.
Every year it just gets better and better and bigger. So it's great.
Oh, I like a
Happy
good
to have
party.
been there.
What can I say?
Disappointed I didn't win the Kachuk signed hockey stick, but you win some, you lose some. Speaking of winning some and losing some, David, offers. Lots of offers going out. We're in the spring market. We're peak spring market right now. I'm seeing a lot of people putting in offers and a lot of people not winning. And we did get some comments last week. Paul Chan was on last week. First of all, apologies to Paul because we kept calling him Paul Zan, and he told us after the show it was Paul Chan. So felt really stupid, foot in my mouth. But thanks for Paul for coming on. He was talking about basically, multiple offers and how, homes are just not sitting on the market. And a lot of people mess just being like, what are you talking about? Like homes are sitting, like things are not moving as quickly as he was indicating. So it seems like even within the city, there's differing opinions as to exactly what's happening in the market, where prices should be, and so on. So like from your seat, your clients, like what are you seeing as far as purchases, transactions, offers? Like what's going on over there?
I'm seeing exactly like what we talked about last week. A lot of the comments or questions were derived from people not really, I found, from listening to the full conversation, but really there are a segment of properties that are sitting for a long period of time because they're overpriced or they're vacant, they're not staged, they just don't show as well. And then there's others which are staged really well priced, show really well, and they're going very quickly. And it's different pockets. There's certainly pockets where there's more supply. That stuff is sitting longer because there's more options. But then there's areas where stuff's flying off the shelves. Like a client wanting to buy in Blackburn. They want a single detached in Blackburn. There hasn't been any available. They had to eventually buy one off market like 2 weeks ago. So it's just, there are pockets where things are just not, that they're moving so quickly that, again, like people are there's multiple offers or stuff not going. So it is very much like, I find like there's no middle ground. It's like, it's either like going really quick or sitting for a long period of time. And so like, that's where I think people are misconstrued as far as what we were talking about. It seems like, if you look at the stats, it seems like when you see 4.6, months of inventory, you say, like, think that there's no way that anything's going multiple offers or anything like that, but it's just because of the way things are priced and the way they show. And that goes to people having rentals that, moved out or wanting to unload them, but they're just in an area where there's just a lot of supply and it's just sitting.
Yeah, and it's kind of what I'm seeing too is the clients that are like, when they send me properties, I look at it and in some cases you can tell right away, like, okay, this is, first of all, underpriced likely for the area, very likely going to go, like they're definitely going to be getting more than one offer on this property. And we're still seeing it where clients are maybe, they want to go in at asking or under asking. And this is kind of what we were saying to Paul, is that there's people that are maybe first time buyers that are looking for that deal. Like they're hoping to get things under asking because they feel it's a soft market, and then they go into a neighborhood maybe where the prices are supposed to be higher than what they're listed at, and the listing agents are maybe doing it well for one of two reasons. One, they actually are pricing it undervalue on purpose to try to get that interest and that excitement and maybe more than one offer, or they just don't know how to price it because of exactly what we're saying, that some homes are sitting, some aren't. So maybe their experience with their recent listings was that homes have been sitting, so they're trying to price it lower to get that activity and stuff going. So buyers going into that sort of, state or that market makes it confusing because they think, okay, this is listed at 499, maybe we can get it for 480. But if the selling realtor is listing at 499, knowing it's worth six, it can be very confusing for the buyer as well. So I find I'm having a lot more conversations about this is typically the realtor's job, but it comes back to us because clients are asking, hey, it's listed at 400, we're pre-approved for 550. Like, how do we navigate this? Like, what is our plan here? So I'm having a lot more of those conversations about like pricing and the market and so on. And especially with rates too, rates are always a topic of conversation for us. But what are you seeing and what do you anticipate happening with rates now with the Bank of Canada's next announcement coming in less than a month? Obviously, we have the new leadership change. Like, where do you anticipate rates going for the rest of 2025? Because that's a conversation that we are fielding almost daily.
I mean, where rates are going to be seen in the last month, we've seen fixed rates actually tick up and jump by 15 and 20 basis points across the board. There's been some articles out with last month's unemployment rate being up, 6.9 with loss of jobs and that being a result of extended tariff issues and talk and costs associated there, which increased the odds of a Bank of Canada slash in June to the overnight rate by 25 basis points. So I don't think rates are looking to go up. I think they're going to go down based on negative impact to our economy, as we're
Yeah.
already seeing with tariffs and things like that, which have already come into play. But I think that's going to continue rippling through the economy. Um, you know, Also where we have the rate. We're kind of starting to see a little bit, but a little bit of a rate war in the sense that um, there are so many renewals up this year that banks are having to be more competitive than they had been because that 1.25 million Canadians up for more or mortgages up rather. They're obviously shopping. So I think rates will continue to have that downward pressure. To what extent, I don't know, but
Yeah.
really I can only look to what the numbers recently have been out as far as like economic data and kind of what those headwinds are from the US and from international partners. I mean, even just as something as small as like just before we started recording this, and it's not even small, it's a big impact to Ontario, but Honda Motors just announced basically 15 minutes ago, I got an update that they're pulling out and postponing their $15 billion investment in that EV plant in Ontario. And they've just pulled out of that, postponing that for 2 years. They're claiming that it's due to lack of demand of EVs, but it's possible that that's a result of the US and then the pressure on Honda from the US to maybe build a plant there instead. What they say right now in that quick article, they're saying it's due to demand, but it could be from those external, which, all of that, all those sorts of things like that was supposed to be 15 billion invested into Ontario, creating 1,000 jobs, things like that, which obviously helps employment and whatnot, and the construction industry and all these offshoots. That doesn't progress. That's another hit to our local economy that just again impacts and causes that downward pressure of rates and bonds.
Yeah. So speaking of on rates, that I put up a window there just about fixed rates because I know people often ask, every time the Bank of Canada makes an announcement, people ask how it affects their fixed rates. And I know we've talked about this. So if you listen every week, I apologize. But there was a chart I put up maybe a few minutes ago just showing like basically the bond chart for the last year and what impacts the fixed rates in comparison to what impacts the variable rates. And it is a common conversation. And as I said previously, like this is one of the times in the last, decade that the rates are fairly uncertain. Like depending on how the economy goes, we could see rates go up if we have a strong economy, if things continue to head in a downward trend, as you mentioned, then, we're going to see potentially rates drop even further. So it depends. Like, we'll see what happens in the coming weeks and months. The April numbers came out just before Paul came on last week, so I wanted to just kind of bring them up here so we can touch on them in Ottawa. Okay, so here we go, Dave. Here's the April numbers. So if we take a look, starting in the top left, this is kind of the summary of the numbers. Shows total new listings in April 2000. This is new listings, 2,589 new listings. Total active listings, 4,878. So that's very high from what I understand. Benchmark price for a single family in April, 103,200. Average days on market, 18. So that's down from, I think, 42 in January or February. Total properties sold, 1,306. Sales activity. So here we go, 2025. In April year to date, 3,965, slightly down from 2024. In 2024, the sales activity year to date was 4,192. So we're down slightly, but still up from 2023. So, I would say that's a fair average. Like, the last 3 years have all been like 3,700, 41, 39. So pretty much on par. Months of inventory, 4.1 right now, year to date. So in comparison to 2023 and 2024, that's a pretty big uptick. 2023 was 2.2 months of inventory. 2024 was 2.5, so fairly consistent. And now we have 4.1 months of inventory. And then active listings pretty much matches the months of inventory, at least as far as like the chart looks. So 2023, we had 2,000 active listings. 2024, 2,500. And currently we have over 4,000 active listings, which is surprising with the 18 days on market. Because
so I think that speaks exactly what we were talking about at the beginning of the show. Like that, when you look at everything, if you kind of put your hand over that top left quadrant and you look at all the other figures, you would say that, things are sitting for ages, things aren't selling, prices are coming down. But when you look at that days on market, that is showing you, and that's the indicator that there are places that are going very, very quickly. That's an average. Like that is kind of where that's showing that kind of split between the two property type listings.
One of the things that I think isn't discussed enough too is that for every one of those active listings, there's an active buyer. And if you have your home for sale, you're usually a bit more aggressive in your buying because you have to find something, So I think it kind of speaks to that, like the number of listings doesn't always reflect the state of the market as far as whether it's busy or not, because like I said, those 4,000 listings, that's also 4,000 buyers that need to get into another home. So they're all kind of looking at each other's properties, thinking if they should, basically do like a swap, right? Like it's like a three-way trade in the market of homes. So I always find that interesting. Something else I'm seeing a lot right now, Dave, and I'm interested to hear if you're kind of fielding these questions too, is as we know in Ottawa, the city's been around for a long time. There's a lot of century homes, a lot of older homes that not even are century homes, but are built maybe in the 50s, 60s, 70s, dated, oven tube wiring, asbestos in the attic, which is all just, was part of the building code previously, and now having to kind of remediate all these issues. So I'm seeing a lot of people asking about properties that are undervalued because of these kind of asterisks on the contents, like the innards of the home, that's causing them to ask about purchase plus improvement programs, construction mortgages. So I've had to field two major questions this week, I guess, just regarding properties that were undervalued. One was listed at $899, or somewhere between $300,000 and $500,000 worth of work, and clients were inquiring about the purchase plus improvement program. So I was just explaining how that worked and what the qualifications were and the program itself. So for anyone who doesn't know, I just wanted to kind of give the contrast between like a purchase plus program, which I've actually had the benefit of taking advantage of myself, and a construction program project, which I think you might have actually dealt with, Dave, but I know we deal with a lender that does that almost exclusively.
Are you trying to grow your mortgage business? CENTUM has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with CENTUM. Learn more at joincentum.ca. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Galtin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at galtinpoirierlaw.ca. Let's get to the heart of your deal.
From the Purchase Plus side, like in this case, typically that's for more of a facelift, I guess, or, cosmetic changes. You need new flooring. You want to update the washroom, install new, cabinets or kitchen contents, etc. So typically you can do up to 100,000. We've seen in some cases lenders go over and above that, but it's an insured program, meaning that, the mortgage does need to be insured by a CMHC, a SAGEN, etc. for you to qualify for that program. So in a lot of these cases where, let's say that it needs $300,000 to $500,000 worth of work, it's not going to qualify for 100,000. This needs new wiring throughout the home, new HVAC, new septic, new everything. Basically, like it's a full remodel, right? It's a $500,000 project that is not going to qualify under this. Under the Purchase Plus program. When I used the Purchase Plus, it was a dated home. Bones were good. It was livable, but it needed updating. So redo the floors, redo the washrooms, redo the kitchen, as I mentioned. You can do window, like anything that's really is going to improve the value in the short term. And you can do it on a semi-detached or a town, 3-bedroom townhome. You can do a lot for 100,000. It's not by any means a small project, but you're not going to be rebuilding the home as you would with a construction project. So in speaking to a construction lender here that is willing to do that, specifically on that 899 property, they were suggesting that the clients would need probably upwards of 35% as a down payment. And then they would be willing to lend 75% of the as improved value for them to use as kind of draws to get the construction financing going. So these are just questions that I'm seeing more and more because people see these homes that are way undervalued. The other one was at 500,000 in a neighborhood where homes are 750, 800. So super attractive when you look at it and you think, okay, well, these cabinets are dated or what have you. But for example, with the knob and tube wiring, insurance companies are not going to insure that homes. If you can't get insurance on your home, no lender is going to finance that property. So there are things that are absolute deal breakers that people aren't thinking of when they're going in and looking at these properties. So are you seeing that more? And just from your own experience, like maybe you can better explain, I don't know if I did a great job, like the difference between the Purchase Plus and a construction type loan.
Yeah, I mean, I haven't been fielding too many lately under those programs, but I've definitely dealt with them quite a bit on both sides. To exactly what you said, the Purchase Plus Improvement Program used to be capped at 40,000. It's been stretched to 100,000 as far as availability for what you can get under that program, which is also a result of the cost of doing kitchens these days and bathrooms.
That's when
like they add
plywood
up pretty
sheets
damn
were
quickly.
$1,000. They're like,
Yeah,
oh, we got to
yeah,
up
exactly.
this. Yeah.
Yeah. So these programs are meant for your cosmetic updates. They're not meant for redoing foundation, but you can use them if you need a new roof, if you need the HVAC replaced, if you need to update that, some plumbing or whatever it may be. That's fine, but it's not meant for the full remodel of a house and all of that. Caveat that people kind of run into is when they have the ideas of taking down walls and this and that. And if you're doing anything structural, you need the permits ahead of time, which is obviously very hard to do on a purchase. And so to have those ahead of time, because you're not in the home, you're not an owner of it, it's meant for foundational. There are some lenders that will allow you to replace the septic using it, but that is a little more challenging because they still want it to be operable on closing, that you can still live in the house. Banks look at it as basically, if you default on the mortgage the day after closing, can this house be lived in, or what's the condition? Can it be resold? Inoperable well or septic is obviously an issue if you don't have plumbing and you don't have water. So on a septic, as long as you can indicate that it is working, that you can find some lenders that will allow you to replace it. But it isn't for, like you said, that $500,000 renovation. But the Purchase Plus, you can do, like you said, up to 100,000. You can get it with minimum down and still get that, get those funds. There's nothing advanced up front though. So for those that are listening that think about this program, you're not getting money up front to get the project started. You're still going to need a little bit of a float, or you're going to need to go to your Home Depot and tap into like a Home Depot credit card, or speak to the contractor that's going to be doing the work, advise them that you'll be able to pay when it's completed. And maybe he's floating the materials and charging a little bit extra for it, but that's all in the quotes up front. So before anything's funded, everything has to be quoted by a contractor. It has to be there, and we get what we get approved for that funding for the Purchase Plus matches dollar for dollar what's in that quote. There's no real wiggle room in that, or like a 10% contingency or something like that. Whereas the construction program, obviously you're going off a budget and what is planned to be done. But to your point, these are massive, these are big renovations. They're wanting it at a lower loan to value, that if you default, they need to get it up to snuff. Like there is that room for the bank to be able to even get it up to be able to sell it, things like that. So they want that larger down payment. And then for that, they're basing it on that future value when the renos are completed, what that value is, and then going to, like you said, that 75% loan to value. And what you're getting for construction money is that difference between your 65% based on a purchase price and that 75% of that complete project. And they're doing it in draws. So as you're going, you're getting a percentage complete, and they're advancing funds throughout the project. But again, you need funds up front to to carry you through. Some that people don't really, where a lot of the conversations on our side, and I know you run into these, Paul, is like when buyers come with 5% down, wanting to do a Purchase Plus for 100 grand, and they have no other money to weather the storm, to get to buy materials or get them through anything.
Yeah.
It's something where it needs to be planned and thought out.
Yeah, and a lot of the times they come, luckily we're in a market right now where people are including financing conditions, like they actually have an out if we can't get the financing. But a lot of times people will just email saying, how can we incorporate the cost of the construction into the mortgage? And like you said, it oftentimes is people that have an insurable mortgage, which is fine and it actually would work, but it's having that cash on hand up front to do the work and then get reimbursed after the fact. That's oftentimes the biggest challenge. The one I was looking at recently was the property that I said was listed at 500. It had a leak in the chimney. It had tape on the windows. It had knob and tube wiring. Everything was dated. The floors were starting to fall apart. Like it's just it was being sold as is, which is obviously another huge red flag for lenders. So I said to the buyers, I said, listen, I said, probably you may not even be able to get financing on this. Like even under a Purchase Plus, like this is not realistic. And on top of that, the home's being listed at 500. It probably sell for closer to 6 or 650. Then you have to do the renovations on top of that. Like it was already being priced undervalued as well as needing renovation. So very confusing. I would understand for a buyer. If you're new to the market, this was a first time home buyer. You go look at a home, it seems like, oh, wow, we're getting a $250,000 discount on this property, but it needs some work. And that's kind of that's the extent of what you're thinking is like, oh, well, let's figure out how we can do the work and we'll get this home at a discount. But it's like I said, it's not going to be a discount. You're probably going to be paying $600, $650, and someone who knows how to do that, or is a contractor, or, has those connections, might be able to get in there for $600 to $650 and do, $200,000 worth of work for 75 or 100K if they have the materials, if they have the experience and the know-how to do that. So it's just, it's kind of apples and oranges as far as these conversations and these negotiations, because there are people who, may not have all of the money, but they have the experience. And there's other people that maybe have the money, but don't have the experience, and they're kind of competing for the same property. So I just find the conversations that it doesn't happen often, but I've fielded a few in the last couple of days with this exact thing, like dated homes needing a lot of work and people trying to find a way to get into them. In some cases, very plausible. In other cases, like, just not realistic, not feasible. I had another client, similar situation, but wanted to use their lines of credit to cover the difference. Like they said, well, we have, 100K for down payment, and then we have another 150K available on unsecured lines of credit. So I was explaining to them, like, not only is that a huge risk, obviously, if things go sideways, but from my experience, construction projects, renovation projects always go over budget. They always take longer than you think. And if you're carrying $150,000 in debt on an unsecured line of credit or credit cards or what have you, like if the project doesn't finish, something goes sideways, you can't get that money back. Well, now you're carrying, a huge amount of debt that's unsecured that you're paying 3% of every month. That's a huge risk and a huge liability. And even the lenders looking at that saying, okay, well, how are they financing this? They're carrying $100,000 on a line of credit for 3 to 4 months. Like the lender may not even accept that because that's a huge risk. They have to factor in that monthly payment now on $100,000 of unsecured debt that they're taking on. So the lender's looking at like the overall financial profile, not just at the property. They want to know like how realistic is it that these specific applicants are going to get this over the finish line.
And none of this is meant to deter people from using these programs. Like they're phenomenal programs. We kind of just use kind of commenting on things that people aren't aware of or keep in mind when looking at them. There is great value to be made on properties from doing the work yourself, utilizing these programs. It's just being aware of what's needed up front. If you're looking at a listing and it tells you that needs TLC, handyman special, anything like that, and you kind of say, just, well, how are they going to know about the condition or that of the property? Well, anytime there is even a reference of those types of adjectives in the listing itself, number one, the lender's going through all the photos online. They're YouTubing it. They're like looking it up on Realtor. They're looking up on House Sigma. They're looking it up on MLX. So they're doing that due diligence on every property, whether it says that or not. They're doing that due diligence. And then further to that, as soon as it has those adjectives in it of TLC, handyman special, whatever it may be, they're requiring an appraisal. And it's an appraiser's going through that property and writing up a report based on its current condition and what the issues are with it. And they're going to dig into that. And if there's, and in some cases, they'll demand to see the home inspection report. Obviously, that's not something we ever look to voluntarily provide to a lender, because obviously home inspection reports, for any of those of you that have ever gotten one, know that they're there as like a list of, even small issues, but things that to be addressed over a long period of time. But if you look at them without having walked through it with the home inspector, it seems very alarmist. But so for a lender to just view that, it could really turn them off. All this to say is, if there's a property that you're showing a client, if you're a realtor, or if you're a mortgage broker talking to a client, or you're a buyer and you're thinking about these properties, just ensure that you are getting the information up front if you're looking at these types of properties, so that you can set yourself up for success on them, because there are more nuances to them. There's more items or documents that are needed up front during the financing process before closing, and then also through that project to get it to completion. And there's also a set timeline. So just ask those questions. If those are the types of properties you're looking at, just have that conversation with your mortgage professional. Let them walk you through those differences between what's going to be a construction project versus a purchase plus, so that you're well aware that you're not wasting your time or anyone's time or money looking at properties that are going to be too outside of the scope of work that you're able to.
It also does need to be your primary home. Like you can't do a purchase plus for a rental or investment property. It needs to be a property that you're going to be actively living in. Just a little FYI, little addition there. Dave, how do you feel about some mood boosts? I got three. I got three today. Number one, people are making too many apocalypse jokes. It's like they think there's no tomorrow. Number two, if number two pencils are so popular, why are they still number two?
Valid question. Valid question.
Yeah, it's more one of those. Valid. That's a good point. And last but not least, what's the fastest way for Harry Potter to get to the bottom of a hill? Running. JK, rolling.
Wow. That's like the epitome of a dad joke.
Oh my. Yeah, I was embarrassed to say that one, but it's pretty funny. Thank you, everyone, for listening, putting up with us. We got a great guest coming next week. Mr. Paul Rushforth will be joining us. He's a very experienced realtor here in Ottawa. He manages a large team, so he's going to kind of tune in and give us some insights on what he's been seeing and what's been happening year over year. Thank you, as always, to our amazing sponsors, Gertin Poirier Avocat Lawyers, Big Insurance in Westboro, and last but not least, CENTUM. Thank you, everyone. We will be back next week, every Wednesday, 10 a.m. Be sure to follow us on our socials. We got some exclusive shorts and content on there. And David, thank you. Thank you for showing up and being here with us every week. Us, being with me. Me and the listeners.
There's no one listening at this point.
Bye, everyone.
Deuces.